I've sold over $50 million in zero DT premium and traded zero DT options every day for over 1,000 consecutive days. But I don't touch a strategy unless it scores well across these 4 dimensions. For those of you that are new here, my name is Mark Anderson, and I'm a construction worker turned zero DT hedge fund manager. And today, I'm going to walk you through the core 4 and how I use these to stress test my next trade. This framework is what separates lucky wins from sustainable edge. When each of these 4 points are balanced, it creates a durable edge. Miss one, you might still make money for a while. But one move in the markets can blow up your strategy and then blow up your entire portfolio. First up of the core 4 is accuracy of price. This is all about mispricing, finding opportunities where something is briefly worth more in one place than it is somewhere else. This is the purest form of edge, also known as arbitrage, and it's nearly a risk-free transaction. Imagine walking into a pawn shop and spotting a rare guitar listed for $500, but you know that it sells online for over $800. You buy it in the pawn shop and then flip it online for a profit. That's classic arbitrage, buying low and selling high in the exact same asset, but in different markets. It's the closest thing to free money as one can get. In finance, this used to happen a lot between different exchanges, but today those opportunities are rare. Algorithms and large hedge funds spot them, act fast, and any human cannot even identify them. Unless you're a high-frequency trading firm with millions of dollars of technology infrastructure, you're probably not going to find this or make a living doing it. So while accuracy of price should be a part of your strategy, you can't rely on it alone. Any arbitrage opportunities are often significantly capacity constrained or very short-lived. The core idea I want to impress on you here isn't just spotting mispriced assets. It's knowing that you're trading in a liquid, efficient market where the price that is quoted is a fair price. That matters a lot, more than most people realize, because even if you do have an edge, it can vanish if the cost to enter that trade is all eaten up by commissions and slippage. Let's say you collect $100 on an option contract, and in order to execute that trade, you spent $10 in commission, slippage, and fees. Then you just gave up 10% of your potential profit to your broker for taking no risk. So part of price accuracy is also market structure. When there are thousands of contracts in open interest, tight bid-ask spreads, and many participants voting on an accurate price, then you can trust that data. It's like having clean inputs into your system. Garbage into your system, garbage out of your system when it comes to data. So a liquid, fairly priced market gives you the foundation to extract premium and edge from the market and test strategies that hold up in the real world. Otherwise, you're just flying blind. And when price is accurate and liquidity is strong, you don't need pure arbitrage opportunities. You can move to the next of the core 4, which is risk premium. This is where most traders live. It's the extra return you earn for taking on more risk than something like the US Treasury bill, or what's known as the risk-free rate. Risk premium means that you're being paid to take on risk, and for your ability to manage that risk, you can take on better than other people in the marketplace. Holding a Treasury bill or a high-yield savings account is about as safe as it gets. So if you invest in anything riskier, like stocks, options, real estate, you need a return above that baseline of the Treasury bill. The difference is what's known as your risk premium. Think about it this way. Right out of high school, someone, let's call him Connor, can take a job in the oil fields making $200,000 a year. Sounds pretty great on paper, right? But it's dangerous. It's physically demanding, and it could potentially take a toll on your body long-term from doing that job. Connor is not just being paid for the work that he's doing in the oil field, he's being compensated for the risk he's taking on as well in that job. Trading's the same way. You get paid for taking on risk and for managing it better than the market. But most traders fall into the trap of just chasing the highest potential payout. They see a high premium and jump without even asking if that premium's really worth it. It's like getting paid $100 to walk a tightrope without realizing there's no safety net. That tightrope is only half of the equation. The real edge comes from when not only you get paid for the risk that you're taking on, but you also have a plan and a way to protect against that risk. That's how you keep the premium, and that's how you stay in the game for the long term. Third is frequency and time frame. How often does your strategy show up and give you a chance to make money? How long do you have to wait to know if you're actually right and the trade works? Let's compare two different approaches. One version enters once with 3 contracts at the best possible time. The other spreads out the entries, 1 contract at a time over 3 different time windows. The second version actually performs better on a risk-adjusted return basis, even if the per trade return is smaller. The overall equity curve is smoother, more consistent, and more repeatable. You're not relying on one single boom or bust moment. And here's why that matters. More frequency means more data. More entries means less of a chance that you're curve fitting. More reps means faster learning and better compounding. It's like training for anything. You don't get strong by doing one big rep and calling it for the rest of the quarter. You get strong by showing up over and over again with consistent form. That's why I love 0DT trading. They give you the daily reps, you get the feedback within hours of trading, and you get a new price environment every single morning. If something major happens, like a Fed announcement or a surprise tweet by Trump, those events are now immediately priced in the next trading day. You're not stuck holding a position built around last month's assumption when that trade was put on. You're starting fresh. So not only are you improving as a trader day by day with those repetitions, you're also reducing your risk, adapting to the market faster, and creating a smoother P&L growth over a longer time frame and realizing that experience. And finally, maybe the most important one, offset of drawdowns and risk. This is your margin of safety, your insurance policy, the thing that keeps you in the game long enough to realize the returns from the other 3 components of the core 4. Because here's the truth. Every strategy looks good when the market behaves the way you want it to. But what happens when it doesn't? Drawdowns happen, and they happen fast. And if you're over leveraged or underprepared, that one bad week can erase a year of gains. That's why this category isn't just about hedging. It's about how you structure your entire approach to trading. Offsetting drawdown risk means sizing conservatively, so you're never risking more than you should. We like to keep each trade in our portfolio under 5% of our buying power to spread out that risk over the day. It also means that you're diversifying across 6 to 8 uncorrelated trades that have different exposures to different markets. So when one underperforms, another can carry the load. This also is using a portfolio approach, not just betting the farm on one single idea. Having the mechanics in place before you enter a trade, meaning your loss is defined at the moment the trade is placed and you have a plan. And sometimes even budgeting a portion, let's say maybe 5% of all the options you sell, you allocate a portion of that to hedge. So you're offsetting risk premium with risk premium. This is the difference between traders who compound and the traders who burn out. It's like driving a truck downhill with a full load. The smart driver isn't the one who just hits the gas. It's the one who knows exactly how strong the brakes really are. When you trust your risk management, you're not trading with fear. You're trading with absolute control. Because if the first 3 components are dialed in and you leave the risk management portion out, this is how your fuel of compounding gets all burnt up, and how you make sure your edge has time to play out is by managing your risk. So let's put it all together. Every strategy that you run should be evaluated across these 4 components. 1, accurate price. Are you trading in a market that gives you a fair price, or are the mechanics stacked against you in a way that erodes your edge before you can even begin to compound it? 2, risk premium. Are you being compensated appropriately for the risk you're taking on? Not just with high premium, but with premium that's worth it. 3, frequency and timeline. How often do you get a valid trade signal, and how quickly do you know if you're right? The more reps you take, the faster feedback you get, and the better evolution you will have as a trader. 4, offset of drawdowns and risk. What's your plan when things go wrong? Are you sized right, diversified enough, and hedged enough to stay in the game long term? And here's the key. These four aren't separate. They're interconnected. They balance each other. You can't just chase high premiums, and you can't just size big when you feel confident. If even one of these pieces is missing, the whole portfolio becomes fragile. That's how smart traders running good trades still end up with bad outcomes. But when you build a system where all four work together, that's when trading becomes scalable, repeatable, and resilient. So here's my challenge for you. Take your favorite strategy and run through this core four. Where's your strategy strong? Where's your strategy vulnerable? If you're honest with yourself, this framework can help your trade become smarter and protect your edge in the long term. And if you want to keep learning how to build real risk-managed systems, hit the subscribe button and follow along. We've got more deep dives coming your way.